Foreign businesses fled China, scores of unemployed people lay on the streets, without homes, and factory workers were forced to quit their jobs. On February 7, 2024, the Shanghai Composite took a devastating dive to a 5-year low, highlighting the severe economic troubles China is grappling with. This alarming drop has left investors shaken and exposed the deep-seated fears surrounding China's stock markets. In 2016, we finally decided to sell the house in Baipio and move out. Currently, we still have a remaining mortgage of $3 million, and after the interest rate cut this year, we pay $16,200 per month. Since buying the house, my husband has been obsessed with stock trading. Until now, he is still heavily in debt and has even lost 2 million yuan of our savings. There have been constant disputes between me and my husband since then. It wasn't until this year that I finally figured out exactly how much money he borrowed and how much he still owes. I analyze the causes and consequences of every matter very rationally. I may list several solutions for myself to see which one is better. Even if we divorce, a huge amount of debt will still involve me and our child. When he gets old, with a huge debt, will our child have to pay it off for him? I have to consider everything. I must minimize the risk to the entire family. The Chinese stock market has experienced significant losses, with the Hang Seng China Enterprises Index losing over 50% of its value since early 2022, causing investors to panic and throwing the market into turmoil. This is a dire situation that threatens to drag China's economy down a perilous path. The future appears bleak, with no clear end in sight to the market's downward trajectory. Investors are fleeing, and confidence in China's economic prospects has been severely eroded. The once strong Shanghai Composite is now a mere shadow of its former self, serving as a stark reminder of the severe consequences of prolonged economic mismanagement. Today, I really don't feel like talking. My account is now less than 40 yuan, and I truly regret why I entered the stock market. I hope those who are considering entering the stock market should refrain and focus on their work. I graduated from Xi'an University and worked as a software engineer at a state-owned enterprise in Wuhan, earning 8,000 yuan per month. At one time, I had around 300,000 to 400,000 yuan. I believed that the stock market had great potential. I also borrowed some money from my family and invested it. My stocks grew daily, and I told my father about my earnings, saying that now was a good opportunity and that my family should invest more as everything would be easier with more money. I borrowed around 700,000 to 800,000 yuan from my dad. At one time, I made 1.2 million yuan. Later, the market crashed severely, and my investments were wiped out. I lost everything. In total, I lost my family's 700,000 to 800,000 yuan and now owe 200,000 to 300,000 yuan. Life became unbearable, and I felt hopeless, not wanting to do anything all day. I started working for Meituan food delivery. Today, I officially started his new job. I'm increasingly realizing that the ultimate destination for stock traders is delivering food. With the decline of the stock market, many sectors follow. With plummeting home prices and the near impossibility of selling properties, even with discounts exceeding 50%, countless middle-class families have watched helplessly as their wealth evaporates before their eyes. The stark reality is exemplified by the plight of a family that purchased a home worth 10 million yuan with a 3 million down payment and a 7 million loan. In the face of a sudden 3 million yuan drop in home value, the property would be worth a mere 7 million, effectively wiping out the family's entire down payment. As property values continue their relentless decline, the assets of middle-class families are being mercilessly eroded. For those who have taken out substantial loans to purchase homes, the specter of poverty looms large. With the slightest disruption to their income, like losing money through stock, these families will find themselves unable to repay their loans, plunging them into a cycle of debt and despair. It's really embarrassing for everyone, and we're losing face even on the international stage. The Wall Street Journal has mocked our Chinese stock market, calling it a massive scam, and then even downgraded their rating, advising investors to stay away and exit quickly. With major players like Goldman Sachs and Morgan Stanley also expressing their doubts about the market, and now the Wall Street Journal ridiculing it, even Larry Baer has something to say. 200 million Chinese investors have lost faith in the Chinese stock market. What exactly has happened? It's shocking to see such influential media outlets and even American politicians relentlessly attacking our stock market's weaknesses, exposing all the flaws of our A-share market to the entire world. Many people want to defend it, but with each consecutive drop and weak rebound of our A-shares, the billions in losses suffered by investors are just too much to bear. So, what's the current state of our A-shares? Consumer spending is weak, and companies are turning to the stock market for financing. The the real economy is struggling and also resorting to market financing. Even the real estate industry, which is facing its own challenges, is now looking to raise money through the stock market. The Chinese government's desperate attempts to rescue the plummeting stock market have proven woefully inadequate, as analysts warn that the measures taken are far from sufficient to restore the shattered confidence of investors. Nicholas Spiro of Laressa Advisory grimly noted that the deeply entrenched bearish narrative surrounding China has become nearly impossible to dislodge, with the country now utterly shunned by global investors. In a last-ditch effort, Chinese authorities considered a highly risky $278 billion package, primarily sourced from the offshore accounts of state-run firms, to prop up the ailing stocks. However, experts caution that even such a substantial initiative would likely fail to lure bears back to the Chinese market. The Chinese stock market, known as A-shares, is often seen as a scam by many investors. Despite this, countless people continue to enter the market, hoping to get rich quickly. The primary purpose of the Chinese stock market is to raise funds for listed companies, not to benefit small investors or increase the income of the common people. Companies prefer equity financing through the stock market over bank loans to avoid paying interest and the risk of bankruptcy. As a result, the speed of IPOs in the A-share market is unmatched. The widespread call to cancel IPOs is unlikely to be heeded, which means the stock market will continue to fall, as evidenced by the recent drop below 2,900 points. Many people enter the stock market hoping to make a fortune, similar to the mentality of lottery players. However, most Chinese people are not suited for stock trading, especially in the imperfect A-share market, where retail investors account for over 99% of the market. Some companies with good prospects and fundamentals are often pushed to unreasonable heights in the A-share market, leading to major shareholders selling their stocks at high positions. Institutional investors, who originally believed in value investing, are forced to sell due to the seriously overvalued stocks. The dreams of ordinary people are often shattered by the ruthless reality of the stock market. Retail investors often follow big players and speculate on leading stocks, which is akin to gambling in a casino. The Chinese A-share market doesn't need valuable companies, it only needs concepts for retail investors to speculate on. Xu Xiaoping, a well-known expert in economics and legislation, shared his view. The biggest problem with China's stock market seems to be the lack of a genuine administrative mechanism for protecting investors' interests when the market drops by 16 points. In the design of our stock market, the focus has been primarily on corporate financing, without adequate consideration for how participants like us can make money. Consider this: when a company raises funds through IPOs, it is essentially raising money from investors. Recently, there has been a circulating table on the internet detailing how much money listed companies raised, the holdings of securities firms, the amount of taxes collected by the government, and ultimately how much profit investors made. Is there such a mechanism in place? If a listed company raises funds and its investors incur losses, there should be consequences. For instance, if a company's investors suffer losses, that company should not be allowed to raise funds for a year. Moreover, the funds raised should be returned to the investors. Without such measures, listed companies can act recklessly. Take Maotai, for example. Despite being a great company, it incurred losses of hundreds of billions at one point. Can it be guaranteed that all investors in Maotai made profits? China's dismal economic performance over the past year has been marked by a wave of devastating real estate company bankruptcies, a mass exodus of foreign capital, and the escalating trade war between China and the United States. This perfect storm of negative factors has only served to solidify the already deeply pessimistic sentiment of global investors towards Chinese stocks, leading to a deluge of short-selling activity. In a stark indication of the severity of the crisis, global funds dumped a staggering net $14.5 billion worth of Chinese stocks in January alone, extending their selling streak to an unprecedented 6 consecutive months. A group of wealthy individuals with assets totaling over 10,000 billion yuan are allegedly organizing to secretly transfer their wealth overseas. China, indeed, has no shortage of affluent individuals. In 2022, it surpassed the United States with 1,133 billionaires, creating a significant lead. It has become the country with the highest number of billionaires globally. However, what about the pioneers who accumulated wealth earlier? Interestingly, more than 10,800 of them have reportedly left the country overnight, taking their entire fortunes with them. For instance, Zhang Yong, the founder of Heidaleo, reportedly took 34.7 billion yuan abroad and became the richest person in Singapore. This phenomenon raises questions about the motivation behind such moves. Are they seeking free healthcare and education abroad? Certainly not, as these tycoons are not concerned about such benefits. Moreover, who says they cannot enjoy top-tier medical facilities, schools, and luxury homes within China. Furthermore, the People's Bank of China, PBOC, seems to be grasping at straws in its attempt to fix the country's economic problems. The bank's governor, Pan Gongsheng, proudly announced that they would lower the reserve requirement ratio, RRR, for banks, which is supposed to pump about 1 trillion yuan or $139.8 billion into the financial system. However, investors are skeptical that this will be enough to make a real difference, given how serious the challenges are. The PBOC claims that this move will encourage banks to lend more money and boost economic activity, but economic experts see it as a weak response to the deep-rooted issues that are hurting China's economy. The amount of money being injected is like a drop in the bucket compared to the massive problems the country is facing. Investors aren't convinced that these measures will work, and their lack of enthusiasm shows they don't have much faith in the government's ability to turn things around. Market watchers and economists are quick to point out that these efforts to stimulate the economy are simply not good enough. The real estate market is a particularly worrying area, with falling property sales and investors losing confidence. This casts a dark cloud over any hopes of a strong recovery. Even with the government's attempts to help, the challenges in this sector are so huge that it's clear the market is far from being optimistic. The box actions seem more like a desperate attempt to show they're doing something rather than a well-thought-out plan to address the root causes of China's economic troubles. As a result, investors remain cautious and skeptical, waiting to see if more effective measures will be taken to stabilize the economy and restore confidence in the market.